What happens to mortgage rates when the Federal Reserve lowers the Fed funds rate? This is Kathleen Douglas, and that's our news this week. The Federal Reserve just cut interest rates by 0.25%, which is the third cut this year. Similar moves were done in September and October. So this shows a slow, gradual easing, not a big slash of rates. But here's where it gets a little more interesting. It's the vote inside the Fed. It was split. One member wanted a bigger 0.5% cut, and two members didn't want any cut at all. This is the biggest disagreement we've seen inside the Fed in years. So, what does that mean for you and your mortgage rates? First, mortgage rates don't move in a straight line with the Fed funds rate. They follow what investors expect for inflation and on a broader economy, not just what the Fed does at one meeting. Because this cut was widely expected, a lot of it was already priced into the bond market. That means mortgage rates may not drop overnight just because the Fed moved 0.25%. In fact, in some recent cuts, they actually stayed the same and even ticked up quite a bit, actually, when the markets read and reacted to the Fed's comments, not just the headline of the cut. Second, the outlook the Feds gave for 2026 matters. Right now, they are only projecting one more small cut next year, and some members are still arguing no more cuts at all. That tells us that the Fed is not convinced that inflation is fully tamed. This means you will likely see windows of opportunity where rates dip and then bounce rather than a smooth decline. If you'd like to follow along with me in the mortgage rates, just give me a call or email and we'll make sure you're updated.